another, what's been a relatively long and I suppose challenging year in many respects. It's an exciting evening for us tonight. We're actually live streaming this event as well tonight. So I presume there are lots of people at home who are watching this live on their computers. Welcome. It's lovely to have you with us. But also thank you to everybody here tonight. It's lovely to have you here. Thank you for coming out. It's a hot, steamy evening in Howick, but we've had a lot of rain, so we must be careful which we wish for, because we're all getting duck feet. The title of my presentation tonight is, the outlook for 2022, a brighter year. And that would then imply that 2021 hasn't been a good year. And actually, that's not really quite correct. So let's just start off by looking at what's happened over the last 12 months and just taking stock on what's going on, because it actually has been a reasonable year for investors, despite all the challenges that we have faced. Thank you, Rob.
Sorry.
It's coming. So there we go. So basically, sorry, these two charts are, they might be quite small from the back there. I hope you can see them, but if not, we can send them to you. But the chart on the left is basically just a couple of global indices. And you can generally see over the course of this year, starts at 100, and most of the indices are up at sort of 115 or 120, which implies 15-20% returns for the year. Now, that is very, very handsome. We always remind investors that investing is a marathon, it's not a sprint. And if you're getting returns in the teens, you should be very, very happy with that. So have a look at this, have a look at the chart. The little light blue line at the bottom, the one that's going in the different direction to everything else, is actually emerging markets. And yet the South African line, which is the line in the red, has actually done pretty well. So not only have we done pretty well this year, but we've also done a lot better than our peer group, which is unusual because quite often we obviously get lumped into the same bracket. And so this is all in local currency, but even if you put it in dollars, the JSE has done about 15% this year. So we had a tough year last year. I think it's worth bearing in mind that this year hasn't been such a bad year. If you look at the right, these are just the main sectors of the JSE. So the light sort of blue line is the mining sector. The green line is the banks and the financial shares. The red line is all the industrial shares like the food companies and the retailers and all those things, and Naspers, Richemont. And then the light blue sort of grey line at the very top there is the property sector. And property has been the best performing sector this year. It was the worst performing last year, but we are in a church tonight. And so the first shall be last and the last shall be first is appropriate. But I think it highlights again more than ever that and what we tried to stress to everybody last year was that to make knee-jerk decisions and to change course at difficult times is often not the right decision. And often, when you're investing, don't look in the rearview mirror and look for answers in the rearview mirror. You need to look forward and see what's coming. So that's just a little bit of background. The next chart basically is the same sort of set of indices. Hopefully.
Sorry, I'm struggling
here. This morning, I don't know, for some reason we skipped this chart out. But this chart is essentially the same set of indices just over a longer period. And I think why I wanted to put this in is just to provide a little bit of perspective. So last year, well, this year, we've still got a month to go, and who knows what's going to happen over the last couple of weeks of this month. But over the last 4 years, if it hadn't been for the US, which is the dark blue line at the very top, it's been a pretty pedestrian performance around the world in terms of shares, and the US has been the star performer. Listen, Europe hasn't been bad. It's done 8% a year for the last 4 years, which is very, very respectable. But it's really been about the US, almost nothing else. But South Africa has performed exactly in line with all other emerging markets at about 4% a year. And the UK has only done 2% a year. So I think what I'm really trying to get to with this chart is just a little bit of perspective, We often think that we are at the bottom of the world and we're hard done by and, everything's going wrong down here. But actually, when you cast your eye around and you look a little bit wider, you realize that maybe we're not in such bad company after all, or we're not alone. We're actually in good company. So tonight, we're going to do something a little bit different. Quite often when we stand here at the end of the year, we go through a couple of themes and charts, and we get to a conclusion and we say, well, actually there's 3 or 4 shares that we quite like that might fit this theme. This year, we're going to actually do something different. I'm going to show you a slide now with a lot of different companies on it. So there's a whole lot of companies on the left that are South African companies, and there will be names that you guys will recognize. And there's a lot of companies on the right which are global companies, and again, there'll be names that you all recognize. And what we're going to do tonight is I'm going to tell you why we hold these companies. So these are all companies that we hold quite widely in portfolios. It's not an exclusive list. I can't put every company up here because the screen's not big enough. I haven't got enough space. But they're just a selection of companies that we like, that we hold. And I'm going to tell you tonight why we hold them as opposed to trying to do it the other way around. So let's get right into it. In our opinion, over the next sort of 2 to 3 years, there are probably 4 or 5 themes that are going to drive the SA economy over the next sort of 3 years. And these themes are in the top corner, the supported consumer. And I'm going to delve into this a little bit more. There's infrastructure, there is digitalization, there's reform, and then there's pockets of excellence. And we always have pockets of excellence because we're a country that has that does have pockets of excellence, sometimes amidst a sea of non-excellence. Let's be polite and put it like that. So some of these companies, all the companies that I showed you on the previous slide, they all fit into one of these buckets. Okay, and that's the reason why we hold them. Now, actually, a company can actually fit into more than one bucket. Quite often, one company will actually qualify to be in 2 or 3 of these buckets. They do vary, but just for the sake of ease, this is where we're going to put them. And so what I want to do now, just for a few minutes, these are very big themes. They detailed themes, and we could spend all night talking about them and discussing them and going into a lot of detail, which we're not going to do tonight because otherwise you are all going to be asleep. But what we are going to do is just give you a couple of little snippets, a little bit of tease to why we think these are important themes. I'm sure over the course of next year in our intuitions and our seminars and things, we will unpack these a lot more as they develop. I'm just going to go through 1 or 2 little ideas and show you why we think this is so important. So let's start off with the supported consumer. And the first thing to note here is that the supported consumer, it's not the consumer, it's the supported consumer. And there's companies like ShopRite and Spar, Mr. Price, Estelle, Famous Brands. Vukile is a property company, it's in here. And you might think, well, what does a property company have to do with the consumer? Vukile owns a lot of shopping centers, and so they obviously benefit, or they are vulnerable to whatever the consumer is doing. So let's start off and explore this theme a little bit. I'm going to show you probably one of the most depressing charts in the world. I did say to you before this presentation started, some of you who I was chatting with, that you all needed to have a drink before I started talking. I hope everybody's got a drink, because if you have a look at this chart, it is a very, very depressing chart. On the right-hand side is a little cartoon by Sapiro. I don't know if you can see it at the back, but Sapiro is a national asset. He's a great source of inspiration and laughter at a time when you often need it. But basically, there's a group of kids sitting in the class, and the teacher's written a lot of different professions on the board. You know, she's written tech and arts and science and all sorts of things, and she's asking the children, so what do you want to be? And the little child in the class is basically saying employed. Yeah. Isn't that sad? I mean, in humor, obviously we make light of a lot of situations, but isn't that a very, very sad indictment of the truth? So the chart on the left is basically our unemployment rate. The number for the 3rd quarter came out yesterday at 34.9%, and we'd lost something like 650,000 jobs over the last 3 months. Now, 34.9%, basically 1 in every 3 people hasn't got a job in this country. But statistics is a wonderful thing. The way they calculate the unemployment rate is that they exclude people who've stopped looking for a job, who got so discouraged that they no longer want to look for a job. They just sit at home and do nothing. So actually, obviously, we all know that our unemployment rate is actually a lot higher than this. But for what it is, this is the official unemployment number. So that is a very horrible chart. And if you actually sit and think about it, there's not much to cheer. But that brings us on to another problem. And the implication of the chart above there is that South Africans are getting poorer. So I'm not sure you're going to be able to read the numbers on this chart, but I'm just going to explain it a little bit quickly. So basically, this is 2017. Let me just walk up here. Excuse me. So this is 2017, and this is 2020. And the right-hand side of the chart is essentially the middle and upper classes. And the left-hand side of the chart is sort of your lower-class workers, your skilled strugglers, survivors, and your ultra-poor. Now, this is research that was done by Standard Bank. But in 2017, there were 31 million people on the left-hand side of the chart, and there were 6.1 million people on the right-hand side of the chart. By 2020, that has changed to 36 million people on the left-hand side of the chart, and only 2.5 million people on the right-hand side of the chart. Now, that's a frightening change in trend over just 3 short years. And it's because of unemployment. It's also because of immigration. Obviously, a lot of people at the top end immigrating and changing the national averages. But it's a rather depressing story, and South Africans are generally getting poorer because our GDP growth is not growing as fast as our population is. And so GDP per capita is actually falling. So if you look at these two charts together, the one beforehand and this one, you need to take a sip of your drinks. And even those online, I would suggest you reach for the fridge now and you grab a drink, because it's a very, very sobering picture that we sort of painted. And if you look at those two charts, you can sort of say, well, then how can you be bullish on the consumer? Because consumer spending is surely under pressure if you take those two trends in isolation. But the point about the consumer is that we're not saying that we're bullish on the consumer. We're saying that we think a trend is the supported consumer, and the supported consumer basically comes in the form of social grants. So over the last 20 years, give or take, the number of people receiving social grants in the country has risen from 5 or 6 million to 20 million people, and that is costing the government, the cost of those social grants has gone from essentially 40 billion up to 200 billion. And the reason why it comes down in those last 2 little blocks there is because it rose exponentially because of the COVID grant, which might come to an end in March next year. So that's how much money we're spending on social grants. Now, I'm not here to comment on whether that's a good or a bad thing. I think if we didn't spend this money on social grants, we would have poverty on a scale that would be unimaginable. So I think it's unavoidable that we spend this money on social grants, and I think it's necessary for the country to do so. But this money actually does find its way back into the economy. The companies that target the low end of the market, ShopRite, Mr. Price, amongst others, are thriving. There's a lot of activity. Actually, a lot of these people who get social grants are also actually quite entrepreneurial. They make a plan, they make a quick buck. But at some point, even if they're on the side of the road and they're selling their little sweeties or their chips or doing whatever they're doing, and there's a lot of them around, they are sourcing some of their product, they're sourcing some of their material from the formal sector, which is where we obviously are investing. So there's a lot of activity at this end of the market, and it's going to continue to grow. And so we think there's a lot of opportunity for companies that are targeting this end of the market. At the top end, you know, where you've got the middle and upper classes, that pool of people is shrinking. There's no doubt about it, whether it's through immigration or whatever the case is. So those companies who are targeting the top end are finding it more difficult, and we've deliberately not investing aggressively in that part. So let's just move on to another theme. So the second theme is basically reform, and I can see the skepticism in your faces. Reform, we've talked about reform for so long, but it never ever happens. But basically, reform, I mean, as I said earlier, some of these companies can fit into other buckets. There's just we've just chosen a handful of companies here. But let's just look at reform. Because basically in the last 5 months, there's been more reform than in the last 20 years. Now, you might be skeptical, but it's true. There's a lot going on behind the scenes, which I don't think we really appreciate. And it's laying the foundation for hopefully better times. I just want to go through 1 or 2 things quite quickly. The first reform is basically on electricity. This is obviously the big one, especially given that we've had load shedding so recently again, and who knows, we might have it at any moment again. We might be plunged into darkness tonight, who knows. But electricity, there has been a lot of reform. The first one was that they have raised the ceiling for your own embedded generation from 1 megawatt to 100 megawatts. Now, 1 megawatt is nothing. I'm not an engineer. I'm sure there are lots of engineers here tonight. But 1 megawatt doesn't do much to move the needle for your company, or it's a small project. You can just produce a bit of local power. But when you can have a power plant that produces 100 megawatts, Now that's significant and that's got scale. So by raising the ceiling from 1 megawatt to 100 megawatts without requiring a license means that companies can generate their own power. But what is included in those regulations that were published was the ability to wheel. And that basically means that you can build your power station. Let's say you're going to build a solar plant, for example. You don't want to go and build it in Hilton because there's never any sun in Hilton and Howick, but you want to go and build it in Uppington where the sun shines every day. So you go and build it in Uppington, then you can feed that power into the national grid and draw it out of the national grid where you need it, where your mine is, where your building is, whatever the case is. And that's very important. I want to say something else about electricity as well. I think this reform was announced in the middle of June, somewhere around about the 17th or 18th of June. I think we were going through load shedding again at the time, which is not surprising. And Cyril came out and said, within 60 days, we are going to, we're changing the regulations to this, and this will be gazetted within 60 days. And everybody cheered that the regulations are changing, and then everybody groaned because no one ever believed that it would be done in 60 days. Well, let me tell you, it was done in 60 days. On the 60th day, those regulations were published. It was probably the first time in living memory that anything's actually been delivered on time. And that, I think, speaks to some of the intention behind government to try and get some of these things moving forward. So we estimate that over the next 10 to 12 years, we could spend over R1 trillion on electricity infrastructure in this country, R1 trillion. And the good news is that that's not reliant on Eskom. So we've got three things in electricity. We are basically allowed to generate our own power. We are at the same time going green, and we're trying to transition away from obviously our coal-fired power stations onto something a lot more green. And then I can't think of what the third one is. I do apologize. I've just gone blank, but I'll come back to it if I do remember it. But those two things are going to drive reform. And obviously the international community is well behind us to try and ensure that we go green, and there's a lot of pressure and funding. So yes, we have to spend some money on the national grid, but a lot of this money isn't coming from Eskom. A lot of this money, R1 trillion that could be spent on electricity, is actually coming from the private sector. And these guys are ready to push the button and get moving straight away. So there's room for optimism there. The second thing is privatization. And I put it in inverted commas for a reason. I mean, we've been crying out for privatization for so long, but maybe that's almost the wrong word. What we've been crying out for is for the private sector to be able to participate in things. And yet the government has said, no, we are the ones who know what we're doing. We are going to do things, and Transnet and Eskom are the companies that are going to do it. But there has been a big ideological shift in the last couple of months about whose role is what. And government has realized that they can't do it all on their own. They have invited bids for the private sector to get involved in the Durban container port, which is one of the most inefficient ports in the world at the moment, which is saying something because actually all ports have got ships stacked outside them at the moment because of these supply issues. They've also announced that they're going to allow to open up the rail network, so you can have private sector operators running trains on Spoornet's or Transnet's rail network. Now, these are very, very big decisions, and I don't really want to emphasize them, because in our opinion, the ideological shift for government to say, actually, we don't have to do it all on our own, we can use the private sector as well, and we can get things moving, is huge. For those of you who enjoy a whiskey, you will know that Johnny Walker's slogan is keep walking, but that implies that you have to take the first step. And in our opinion, this is a very, very, very big first step. It's going to take maybe another 6 or 9 or 12 months for these regulations to come into place and for the projects to start getting off the ground. But you have to have the first step. And it's been a massive, massive shift this year in terms of the way government is thinking about it. And the private sector is excited. I mean, we talk to a lot of different companies, and they're excited by the opportunity. They're seeing some changes, they're seeing some action, and they are gearing up for better times. The third one that we should really focus on is spectrum. So you all know when you sit there and you download something and the little circle goes round and round and round and you're waiting for it. Oh, wouldn't it be nice to have faster internet? We can't have faster internet, or we can have fiber. You know, we've now got fiber in Howick, which is exciting, but we need 5G. We need more spectrum to allow cell phone companies to invest in their networks and to bring us 5G. The last time spectrum was auctioned in this country, I think, was in 2006. And you know how much technological advancement we've had since 2006 in terms of cell phones and IT. So the whole thing about spectrum has been bogged down in legal wrangles for probably 5 or 6 years, everybody accusing everybody else of wrongdoing, and it's been tied up in court. And in the last, literally probably 2 months, the whole industry has come together, agreed that everybody is going to put aside their court challenges, go back to the drawing board and reissue the spectrum. In addition, ICASA has extended the temporary spectrum that they allocated it during COVID last year to make sure that the actually improved service that we've been enjoying over the last couple of, I suppose, 18 months isn't taken away. Now, spectrum is huge because as soon as the companies get the spectrum, they are going to invest billions and billions of rands in improving our cell phone infrastructure. And like all of these things, these are all enabling technologies, or not technologies, but they enable the rest of the country to perform better. If you've got good roads, efficient railways, good ports, good internet, that allows other businesses to thrive and do their thing. So that's why infrastructure is so important. So if we just move on to the last theme, which is infrastructure. Again, I mean, we can put a lot of different companies up on this list, but 2 that we've just highlighted, which I wrote about in Intuition last week, are Roynet and Afrimat. Now, unfortunately, if you look at the chart on the left, there's a rule of thumb in economics that says you should be investing 25% of your GDP in infrastructure every year. Otherwise, you're consuming your infrastructure and you're not adding to it. We actually hit that 25% level once, I think in Q2 of 2009, just before the World Cup. But when they revised the GDP statistics about 2 months ago, that ratio has now changed. So now it doesn't look like we've ever hit it, which is probably more effective because we probably haven't really hit it. But we actually did get there once. But just have a look at that chart on the left. Just look at where we are sitting. We should be investing 25% of our GDP in infrastructure. Where do we sit? 14%. And I don't think I have to explain to anybody here or online that the signs are visible everywhere. Crumbling infrastructure, leaking pipes, sewage that doesn't work, roads that are potholed, you name it, the list goes on and on. If you look at the chart on the right, that's a breakdown between what the government does and what the private sector does. The government is the blue line and the private sector is the red line, and those 2 added together will give you the chart on the left. And you can see that from a public sector point of view, government and public municipalities, the ratio has seldom been lower since the democratic era. That's where we're basically sitting at the moment. And so we all know this. The good news is that there's actually a glimmer of hope. Robert, thank you. So unfortunately, one of the big casualties of the last 10 years in this country has been the construction industry. Everybody geared up over the World Cup. And just think back to where we would be today if we hadn't done that infrastructure for the World Cup. There wouldn't be King Shaka Airport. There wouldn't be the Gautrain. There wouldn't be the Gauteng Freeway Improvement Project where they widened all the freeways around Gauteng. Just imagine the chaos if those highways were still, 1 or 2 lanes narrower than they are today. If we hadn't invested in the infrastructure. And that's why infrastructure is so important. Now, there are not many listed construction companies left. They've all fallen by the wayside. But the 2 that are thriving are Wilson Bailey Homes and Robex. And so what I've done on this chart is I've basically gone back over the results of the last sort of 4 or 5 years and added up how much work they have in South Africa every time they report their results. And this is an indication of all the work that they've secured that they're going to execute over the next sort of year or 2 or 3. I mean, construction projects are generally quite long term. So in June 2018, collectively, these 2 companies, and this is just South Africa, this is not what they do in Australia or the rest of Africa or the UK, they had about 14 billion rands worth of projects on their books. When they reported in June, that figure has now risen to sort of 28 billion. There's plenty of work around. When we talk to companies, you might all seem a bit skeptical. Obviously, if you drive to Durban, you will see that there's lots of progress on the N3. But when you talk to companies in the sector, there's lots of activity. They're excited. They're tendering for new projects. There's lots of stuff going on. They're not all scrabbling for the same bone. There's enough for everybody to go around, and they're busy. And so I think there's a lot of encouragement to be taken from that. And then, Afrimat, which is a company that we like, as a part of their community service, I suppose, or their industry insight, if you want to call it like that, they publish an index which basically tracks conditions in the construction industry. And you can see what that index has done over the last sort of 3 or 4 years, and then it took a real dive during COVID, and not unexpectedly, but that index is recovering quite quickly. And actually, they publish it quarterly. It's due to be published for the September quarter any day now. It might even come out tomorrow or on Monday or something like that. So I haven't got the latest number, but when it does come out, I'm sure it's going to be quite sharply higher than where that number is at the moment. So what's the impact of all this reform? Why do we get so excited about all this reform? Because basically the Reserve Bank or Treasury, they calculate that at the moment our economy can only grow between 1.5% and 2%. That's the maximum it can grow because of all the constraints that are on it. We can't grow any faster than that because the economy actually, it's a bit like a 50-year-old car. It just cannot get past first gear. It's just, but if we do all this reform, if we put a new engine in and if we tune the brakes and if we put a new exhaust on, we can actually get to 3.5–4% GDP growth in this country just by enabling this reform. And that's before the multiplier effect kicks in. So obviously, if you have a big construction project, you're going to employ lots of people. They're going to get paid. They're going to go to the local shop and spend their money. And in turn, obviously, that shop does well and he goes and spends money. And so the whole thing cascades down through the economy. And that's what the multiplier effect is. So if we get some of these reforms right, and if we get some of these reforms moving, we are going to move from this potential low growth scenario that we've been stuck in for the last 6 or 7 years. The last time we had growth rates above 2% was in 2014 or 2015. That's quite a long time ago, except for last year, but that was just because of base effects. That's just statistics. It wasn't true growth. So that's very exciting. So if you take that and you take the potential for our growth to accelerate and you couple that with actually shares that are quite cheap on the JSE, the picture is actually quite encouraging. Shares on the JSE are not expensive. We've had a good year this year. Shares have recovered quite a lot from last year, but earnings, profits have recovered even more. And I think what we are seeing on the JSE is a resilience that people didn't expect. No one expected some of our companies to be this resilient. I think the other thing that we're seeing is that companies over the last 5 years, because things have been so tough, they have cut costs and they've cut costs and they've cut costs. Now that's not necessarily good. That's probably partly reflected in the unemployment chart that I showed you earlier. But what it does mean now is that when things start to get better and the revenues start to grow, that the profits come through in leaps and bounds very quickly. And that's what we're starting to see. So South African companies are not expensive in their own right, but relative to the rest of the world, which is on the chart on the right-hand side, we're as cheap as ever. So if you're sitting in London or New York and you're looking around the world for opportunities, South Africa is starting to look quite interesting. So we're not saying that we are going to blow the lights out next year. All we're saying is that we've actually got some of the building blocks for better growth are finally falling into place. It's been a very, very long wait. And we're coupling this with reasonable valuations. We're not expensive. And from that point of view, to generate double-digit returns from equities is actually very easy. So that's a little bit on the local side. Let's just move on to the global side. Again, we've got a few global themes that are driving the markets. Instead of the supported consumer, I mean, globally, they don't need any support. You've got the aspirational consumer. You've got people who are getting richer, whose incomes are rising, and they want to spend that money in different ways. We've got infrastructure again. We've got alternative energy. That's probably one of the big changes over the last 18 months is the awareness about the environment and the desire to do something about it, I suppose. And obviously, digitalization and the Internet of Things and fintech and all the stuff that's happening on the tech side that is driving the way we live and work. And we'll probably all be servants to robots in 10 years' time, the way things are going. But let's hope not. So I'm just going to talk about one thing, and that is infrastructure. But these two things actually merge. Alternative energy and infrastructure, they're not the same theme, but I'm going to show you that basically you can participate in these themes through various ways. So you look at, you think about alternative energy and you think about batteries and you think about electric vehicles and you think, oh, I must go and buy a Tesla. But Tesla's on a valuation of crazy, 600–700 times, and yes, there's a lot of potential in Tesla, but if something goes wrong, there's not going to be anywhere to hide. But let's just look at maybe a different angle on the whole thing. So the chart on the left is basically showing you the proportion of sales in each country. I mean, the proportion of cars that are sold, how much are electric vehicles and how much are internal combustion engines. And so basically Norway is the country at the bottom, and 80% of all new cars sold in Norway are electric vehicles. And that's not surprising because Norway has huge tax incentives if you buy an electric car, and they punish you with other taxes if you buy a combustion engine. So their whole tax structure is working perfectly. They're encouraging a different kind of behavior, and people are buying electric cars left, right, and center. And so you can see generally in some countries in Europe, the move to electric vehicles has been quite rapid. But the two biggest car markets in the whole world are the two countries at the very top of that list, the US and China. So the US, under normal conditions, sells about 18 million cars a year. In the China, it's probably about 22, 23 million vehicles a year. And they are the ones where penetration is the lowest. So as the world moves to electric vehicles, and obviously the momentum is just gaining, it's just rising exponentially, the demand for those, for the resources that are required to make those cars go rises exponentially too. And one of those, so everybody thinks about lithium or things like that. It's quite hard to invest in lithium, but copper is often overlooked. Now, in renewable energy alone, so this is renewable energy, solar or wind or electric vehicles, the amount of copper that's going to be required to fuel this drive, this move, this change to electric, to green, to electric, to a new way of energy, a clean energy, is going to rise from 2 million tons to 4 million tons over the next 10 years. That's just the drive to electric energy, not or to green, to renewable energy. There's not all the other things that we use copper for, the plumbing pipes in your house and all the other bits and pieces. That's just from renewable energy. Now, there is not enough copper in the world to basically meet that. You can see what's happened to the copper price. It spiked in 2006, 2007 when China was going crazy and they were building everything in China before they hosted the Olympics back in 2008 in Beijing. And then it obviously sort of tailed off, and now copper prices have gone crazy because basically if you bring on every single mine, every single new mine that is currently under construction, copper mine, there's not enough copper to meet that extra 2 million tons that is going to be required. And so, you know, when people talk about alternative energy, you can think about, yes, I want to buy into a wind farm, or I want to buy into Tesla, or I want to buy into an electric car maker. And yes, there's obviously ways to play it, and there's a huge market for those vehicles and things like that. But there's other ways to play these themes too. And the big mining companies, Anglo, Billiton, and Rio, have all got large copper portfolios. They mine and produce a lot of copper. And they are very, very safe companies. They've got no debt. They produce huge amounts of cash, and they're attractive. So I think the point of this is just to say that there are some global themes, but you don't always have to maybe invest in them through the conventional route. You can get access to some of these themes through a slightly unconventional route where you're paying very good valuations and you're getting very good value for your money. Right. So this photo was taken off Durban on Sunday. No, it wasn't. The sea is never that calm in Durban. But it's not all smooth sailing, as you always know. There's always a few risks. And if the last week has shown us anything, it's that COVID hasn't gone away. I mean, I don't know how many people in this room or how many people online have had their plans changed or thwarted by what's happened in the last week. I know that our family has been affected, and you know we've got to roll with the punches. But it's frustrating. COVID hasn't gone away, and it's going to be with us, and we have to roll with the punches. But we're all aware of COVID. That's not the risk that I'm going to talk about. But I do want to mention one thing on COVID before I move on to what the risk I actually want to talk about. I was attending a conference last week. It was in the UK. Unfortunately, I wasn't in the UK. It was online. I would have loved to have gone to the UK just to have a change of scenery and to be cold. There's lots of snow in the UK at the moment. But I was attending this conference online, and there was a professor from Edinburgh University talking about COVID and sort of where to from here. And basically, you know, Merck have developed a pill, not a cure for COVID, but a pill that obviously is useful in I suppose preventing or curing COVID. And when they were doing the clinical trials on this pill, they basically stopped the clinical trials because they thought it was unethical to continue. And when the lady said this, the professor said this, you could almost hear the collective audience go, "Ooh, big pharma, you know, unethical." You know, we knew they were unethical. But actually, what she meant and what she elaborated on after that was that it was unethical to continue because the pill was so effective that to give people who were sick the placebo and not to heal them was unethical, because they knew that they could heal those people and make them better again. And so admittedly, this was 2 days before the Omicron variant was announced. So maybe things have changed, but I don't actually think they've changed that much. And her prediction was that maybe by this time next year, we would be living with COVID like any other thing. So with this pill, basically, you only take it when you get symptoms. You take it for a couple of days and hopefully you get better, which is basically what we've all been used to for the last 100 years. That's a pretty normal thing for all of us. So let's hope that she's right and that despite what we're going through at the moment and the chaos that has been caused in the last week, that we will look back and say that this was the turning point and it's onward from here. The risk that I really want to talk about tonight is inflation. Everybody's talking about inflation, and rightly so. Because if you look at the chart on the left, this is US and European inflation. Inflation hasn't been higher. Sorry, Robin.
Sorry, I'm having some technical difficulties.
There we go. The chart's gone. If you just look at the chart on the left, inflation in America hasn't been this high. So their inflation rate, equivalent to our CPI, was 6.1% in October. It hasn't been that high since February 1990 or 1991. That is 30 years ago. And a lot of people, especially in our industry, don't even know what inflation is. They've never really experienced inflation, whereas we're actually all quite used to inflation. We've had inflation around for quite a long time. But you know, inflation we don't really think is going away anytime soon, well, not to the extent that it needs to. Yes, the oil price has fallen in the last couple of weeks, which is a welcome relief. As we were talking earlier with some people, hopefully our Department of Energy will correct the fuel price and not get the calculation screwed up again next month. So the oil price has come down, which is obviously quite useful. But one of the key drivers of inflation at the moment is wages. And as Robin often talks about in the office when we have our investment meetings, last year there was a thing called the Great Resignation, where a lot of people resigned. They enjoyed staying at home and doing nothing and getting paid for it. And to entice them back to work is now proving to be quite challenging. You know, they're not coming back to work. And that's the reason why in England, they've got empty supermarket shelves and they've got petrol stations that don't have fuel. And we can all have a quick smile at that because it doesn't just happen here. It's because there's no lorry drivers. Part of them have all gone back to Eastern Europe because of Brexit, but the other half don't want to work under the same conditions. So they're going to drive lorries in those conditions. They want double the salary. And you're having to pay up and pay these people double the salary, otherwise they're not coming back to work. So inflation is rising, wages are rising, and it's obviously, that's an isolated example, but it's happening across the world. In America, one of the reasons for all these supply shortages is that it's the same thing at the harbors and the railways and things, that people don't want to get back to work. I mean, they want to get paid a lot more, and there's a sort of standoff. And China has exported deflation to the rest of the world for a long time. But even in China, inflation is rising quite rapidly at the moment. They're no longer producing goods cheaply and selling them out to the rest of the world, and every year your TV gets cheaper and cheaper and cheaper. That's not really happening anymore. Now that TV is actually going to cost a little bit more. So inflation is here to stay, in our opinion, for a while. I'm not saying it's going to get out of control. We don't think so yet. But there is a risk that it gets out of control. And the way you control inflation is obviously through interest rates. And so interest rates have already started to rise. In our country, we had a hike in our interest rates 2-3 weeks ago now. You can see that on the chart on the right. But in America, which is obviously essentially the bellwether for all interest rates around the world, you can see the blue line is basically a market-related line. It's the 2-year interest rate in America, and that changes every day according to what the market thinks. The light blue line is essentially what the Federal Reserve does, like our Reserve Bank, when they actually formally change interest rates. But the market is telling you that interest rates in America are going up, and that's pretty clear. But interest rates need to rise. And even in our country, if we think that interest rates might get to 5% next year in this country, and everybody thinks, oh, we're going from 3.5% to 5%. But look at where we've come from. We came before COVID at 6.5%, 7%. So yes, interest rates do need to rise, but we're still going to be very accommodative relative to where we were just sort of 18 months ago. And the reason why interest rates need to rise, and it's so important to get inflation under control, is actually on the next slide. So I want to just focus on the chart on the right for a moment. You guys with long memories, and I said this morning that actually everybody in the room's got a longer memory than me, because hopefully I'm the youngest person here. But If you look at the chart on the right there, and you go back into the 90s, we had high inflation. You will remember inflation of between 10 and 15%. And you remember that we had interest rates of between 10 and 20%, depending on where the inflation rate was. And then that horrible spike in 1998 when interest rates went to 24% when the rand collapsed because of the Asian crisis. But generally, over the last 10 or 15 years, when the Reserve Bank introduced inflation targeting in this country, and they have a range that they want inflation to be between 3 and 6%, you can see in the last 10 years, the red line on that chart, how successful inflation targeting has been. Inflation expectations have come down, and inflation, give or take, has averaged 5% a year. And with that, the whole interest rate curve has fallen, and interest rates are structurally lower now than they have ever been in the past for us as a country. If we then focus on the chart on the left, this is basically returns from asset classes. So if we think that inflation is coming, what do we do about inflation? How do we react? And the worst thing you can do is to panic about inflation and move into an asset class that is not going to protect you from inflation. The only asset classes, we sound like stuck records on this sometimes, but the only asset classes that really protect you from inflation are equities and property. And if you look at the dark blue lines, that's basically the average real return. So that's less inflation of all the different asset classes over the last 60 years. Now, 60 years is a long time. If you look at the light blue bars, that's over the last 20 years. And I suppose the most noticeable thing in the light blue bars is that the bond bar is significantly higher. And so bonds have actually been a pretty good investment over the last 20 years. But that is because interest rates have structurally fallen in this country. We've gone from a period where interest rates were very, very high to a period where interest rates are structurally much lower. And that has driven bond yields. If we're going to go into a period where inflation is going to rise, and if inflation rises globally, it's going to be very, very difficult for us as an individual little country not to have some of that inflationary pressure come through to us. But if inflation is going to rise, then we have to expect at some point that interest rates are going to rise along with it. And then bonds and cash are not necessarily good investments. They don't protect you from inflation as well as equities do. So in the transition between low inflation and high inflation, you can have volatility in markets. And one of the reasons for that is that one of the inputs, when you value a share, one of the variables that you use is the interest rate. So when interest rates are very low and you input that variable, you get to a certain share price. And then when interest rates rise and you change that variable and you put a different interest rate in, the valuation changes. And so when expectations around interest rates are changing, then that's why markets get a little bit volatile and share prices go up and down all over the place. But see it for what it is. It's just volatility, but it's not the end of the world. And actually, if you are concerned about inflation, the place you want to be is in equities. And the last chart really just basically sums this up. It really just shows you the real growth in dividends over the last 20 or so years. So this is the real growth. This is, again, is adjusted for inflation. We've taken inflation away from this. So the chart on the left is just every single year individually. And only really in 3 years have dividends not grown at a faster rate than inflation. So the first two little bars there was in 2002, 2003, when we had a recession after 9/11. Obviously, the long big bar is the financial crisis, and the small little bar, well, the smaller bar on the right-hand side is last year, COVID. But if you look at the chart on the right, or what I've basically done on the chart on the right is the very right-hand side is just 1 year. So over the last 12 months, dividends have grown at a rate of, sorry, I can't even read my own writing in my glasses, 11% faster than inflation. Over the last 2 years, which is the second last bar, they have contracted, and that's because we haven't had time yet to let COVID work its way out of the system. And then, the third bar is the last 3 years, and the fourth bar is the last 4 years, and so on and so on. And it's the average return. But we always say to clients that you should expect your dividends or your equities to grow at about 4% faster than inflation. And that red line is 4%. And generally speaking, that relationship holds. It hasn't held for the last couple of years because of the trouble that our economy has been in, but generally it does hold, and we would urge people to consider that. So that really brings me to the end of the presentation. I think it's really a story of I don't really want to focus too much on COVID tonight because I think we're also bored of that. I don't think, we're not saying that COVID's gone away or that the impact won't still linger for a while. But I think the message we want to leave you with tonight is that there's actually been quite a lot of improvement, essentially behind the scenes or below the radar, that is laying the foundation for much better times. So it's not always apparent. What happened in July, especially for us living here in Natal, was traumatic, and it certainly set us back a few paces. But we talk to a lot of companies, and we engage with them. And I would like to leave you with the message that when we talk to all our companies out there, there is definitely a mood of optimism around there. There's stuff going on. They're not saying that conditions are easy. They're not saying that it's a free-for-all and it's the best time they've ever had. There's an optimism. There's an attitude of let's get out there and do things. They're opening new shops. They're doing this. They're building new stuff. And they see opportunity. And some of the reform that's happening finally, after years and years and years and years of waiting, is finally coming to the fore, and it's going to hopefully drive some of that growth over the next couple of years. So it's not going to be easy, but if we can even get to a 2.5% growth rate, it's going to be the highest growth rate we've had in sort of 7 or 8 years. And it's going to be significantly, it's going to feed through very nicely into local shares. So don't be too despairing. It's Christmas. Someone said, are you going to give us a message of hope? I hope I have given you a message of hope. I don't think the outlook is as bleak as it is, as it sometimes is. And so basically with that, I just want to end off. We haven't seen you for a very long time. We were aware of that. We miss you. I hope you miss us. But we are always in the office. But it is a chance to answer a few questions and just to have a chat. And if anybody does have a question, please answer it. And then after questions, we're just going to have our traditional little Christmas raffle just to say thank you for your support. And let's hope that next year we can do this far more regularly and that we can be back in business and hit the ground running. So thank you very much. Are there any questions?
Don't forget to pay the rent.
Oh, sorry. I forgot this morning as well. Last night, we were given a Christmas present. And I said to Robin, when we put the slide in this morning, is this a Christmas present to us or is this a Christmas present to our clients? It's actually a Christmas present to both. Last night we were awarded an award from Citywire for the best property fund in the country, the Harvard House Property Fund, and we were nominated for that, and we won that best fund group. So we don't like to really blow our own trumpet, but we sit down here in Howick and we all live in Howick because we love the climate and we love the slow, not the slow pace of life on a Friday afternoon, but we love the more maybe genteel pace of life rather than a big city. But we want to let you know that by choosing to invest with us, you're not opting for second best. We can hold our own with the best of them. So thank you very much. Robin's the marketing person. I'll be chastised in the office for forgetting that tomorrow. Second time. Are there any questions? Yes. Yes, Vic.
You mentioned distill early on in the presentation, and we can put the 50 right now. Is that a positive thing? And how can I pick SAP? Are they not being monopolistic?
I think the first thing to answer that question. So yes, so if people online didn't hear the question was that Heineken have put an offer in to buy Distell, which will probably go through, and Distell will be delisted. And what is the implication? Is that a good or a bad thing? I think the first thing to recognize from that, and it's not the first time. I mean, if you remember back 18 months, Pepsi bought Pioneer Foods, which owns Penutro and Weet-Bix and lots of other brands that I can't remember off the top of my head. I apologize. But I think the first thing to take from that is that we have good companies down here. We have good companies that are doing great things that are not expensive. So Heineken's looking around the world and they're saying, well, there's an opportunity. There's a great company that we can buy instead of going to do it ourselves. So they basically created a three-way merger. They're buying Namibian breweries at the same time, and they're merging it all together to create a big, essentially Southern African drinks company that can compete effectively with Anheuser-Busch or SAB. and obviously be a springboard into Africa for all the other products and things like that as well. So is it a good or a bad thing? Listen, I think it's a great thing from, I think from a country point of view, it reaffirms that we've got great companies down here, and I think we should be proud of that. From an investment point of view, it'll be very disappointing that Distell's not listed anymore and it disappears, excuse me, as one of our choices in portfolios. But Remgro, which is an anchor shareholder in Distell, is going to remain a shareholder in the enlarged business. So we still can buy Remgro and have access to this bigger company and obviously the growth that they anticipate that they're going to get. So yeah, I don't think it's a bad thing. I think it does just highlight that, you know, everybody says that South Africa is a write-off and that we don't have good companies and who wants to invest in South Africa. And yet Heineken is buying Distell, Mondelez, which is another company that we like overseas. And Mondelez owns Cadbury's and they own Oreos, if you like your chocolate biscuits or something like that. They have made a bid to buy Snackworks, which is sort of essentially the baker's part of AVI. And so why would these companies be coming down here and buying our companies if South Africa was uninvestable? So I think from that you should take a positive. I mean, companies take a much longer term view. I think the problem with sometimes with the current investment climate and all the news and all the social media and the immediacy of news and how quickly it spreads is that all our points of view have become very, very short term. Whereas Heineken or Mondelez or Pepsi, who bought Pioneer, they take, or even Anheuser-Busch, they're taking a 10 or 20 year view. They're not looking at the next quarter and saying, where am I going to get 2% or 1%, you know. So they see a lot of value in our companies. And I think, you know, it's been a catalyst this year for South African fund managers to actually reappraise local companies and say, what is it that they see that we don't see? And actually local shares have done well because I think people have reappraised the fact that local shares were too cheap relative to the quality of the companies that they are. Sorry, that's a long answer. I hope it's answered your question. Any others? The bar's waiting. Okay, if there's no other questions, listen, the teams, if everybody's here from, well, there are a lot of people from the team here. Please do stay and have some snacks with us and have a drink. It's lovely to be able to share some hospitality with everybody again and to sit and chat and to catch up with everybody. It's lovely to see everybody's face. So please don't brush off. And we're just going to finish off with the raffle.